with the companies such as, say, Wesfarmers, if we use that as an example for how we verify what's happening, Wesfarmers has got a number of different elements to it. The two main ones would be Bunnings and the Coles supermarket business. Now with Bunnings, if we take that first, it's a fantastic business. Domestically, it's a really strong franchise, and they've now recently gone into the UK market. So we've spent some time in the UK and observing what's going on with the different competitive landscape over there. So we found that it is a different landscape. We found that there's a different route to market with respect to the trade channel, for example. There's a major competitor called Screwfix, which operates in a very different way in which the trade operates here in Australia. Similarly, the actual footprint of the stores that they bought over there are very different to the Bunnings stores over here. So all these sort of little question marks are things which we're flagging, and it helps us look at how successful they could potentially be in the UK. If we flip over to say Coles, that's been a business which has turned around fantastically well under the current and prior management team. What we're looking at in Coles when we're going offshore, whether it be the US or the UK, and particularly the UK, has been the impact of the likes of the hard discounters. So if you look at the Lidls and the Aldis of the world which operate there, and that's had a really big impact on the way the margin structure has come down. That's one thing which we're looking at. And similarly, the private label architecture and what actually goes on in how things are being priced. Coming back closer to home, if we think about the verification process in Australia, there's so many suppliers that we sort of knock down the doors of. So we're talking to everyone from the fresh through the meat department through to suppliers across the dry grocery line. And a lot of that work goes towards understanding what's actually happening behind the scenes. So what's happening with the shelf prices, what's happening with who's funding the discounts, and also what's happening on the landlord side in terms of the landlord structure and the leases and the like. So there's a whole bunch of work all across the supply chain which allows us to get an insight into how the short, medium and longer term sort of outlook for someone like a Wesfarmers will be. Well, it certainly can, and it's got it's not just upside but also downside. So the way in which we operate is that we're not just looking for businesses in which to invest in, we're looking for businesses which we need to avoid as well. So Wesfarmers is a large index weight in our market. So if we have a view that that's not going to travel particularly well, then not owning it actually provides for performance. So it works both ways for us. Which is why that investment is really valuable. Initially, our research is showing that with respect to Bunnings in the UK is that things are slower than expected. So some of the aspects that we identified, whether it be the footprint and the time it will take to reshape that footprint, is taking longer than expected. And also the observation that prices were particularly high in the home-based business that they bought, and the need to reset those prices down. That's played out in slower like-for-like growth as prices have come down and volumes haven't quite caught up yet. So those are some of the things in which we've identified and we can see sort of playing out. So those are some good examples.